January 14th, 2026, 9:47 a.m. Eastern Time. Silver breaks $90 per ounce for the first time in recorded history. Not 89.50, not a brief spike that gets walked back. A clean sustained break through $90 with volume that suggests this isn't technical noise, this is structural change. 48 hours earlier, silver was trading at $76. That's an 18.4% move in 2 days. To put that in perspective, the S&P 500 moving 18% in 48 hours would represent a gain or loss of roughly $8 trillion in market value. That's the scale of volatility we're witnessing in silver right now. But here's what should terrify anyone paying attention. This isn't happening in isolation. Gold hit $4,187 per ounce this morning. Bitcoin briefly touched $100 at $3,000. The dollar index fell 2.3% in the same 48-hour window. And Treasury yields spiked to levels not seen since the 2008 financial crisis. Something broke. And I'm going to show you exactly what it was, why it happened in this specific 48-hour window, and what the historical patterns suggest happens next. Because this isn't the first time we've seen this pattern. It happened in 1980, it happened in 2011. And every time the same sequence played out. Accumulation, suppression, break, and explosion. We just entered the explosion phase. And if you understand what's happening right now, you'll see why this move to $90 might be just the beginning. Let me start with what actually happened, minute by minute, trade by trade, because the details matter. The 48-hour timeline, January 12th, 2026, 6 p.m. Eastern. Asian markets open. Silver is trading at $76, $20. Gold at $4.89, nothing unusual. Standard Sunday evening positioning as traders in Hong Kong, Singapore, and Shanghai come online. By 8:30 p.m., something changes. Silver jumps to $77.50 in 90 minutes. That's a $1.30 move on relatively thin volume. Market observers note unusual buying from accounts linked to Chinese state-owned enterprises. Not confirmed, but the pattern matches previous accumulation episodes. January 13th, 3 a.m. Eastern, London opens. Silver is now at $79. The move accelerates. By 6 a.m., $82. By the time New York traders arrive at their desks, silver has gained $6 in less than 12 hours. Here's where it gets interesting. COMEX opening at 8:20 a.m. Eastern should have provided resistance. Historically, when silver spikes overnight, the New York Open brings sellers. Algorithms kick in, market makers provide liquidity, prices stabilize or reverse. Not this time. Silver opened at 82.40 in New York and immediately ran to 84. Then 85, then 86. By 10 a.m., 87.50. The bid-ask spread, normally tight at 3.5 cents, blew out to $1.20. That's not a market, that's a scramble. Reports from traders on the floor describe chaos, orders backing up, limit orders being blown through, and most telling, registered silver at COMEX warehouses dropping by 4.2 million ounces in a single day. That's roughly 130 metric tons of physical silver removed from available delivery stocks in 24 hours. By market close on January 13th, silver settled at $88.20, a single-day gain of 15.8%, the largest one-day percentage gain since March 1980 when the Hunt Brothers corner was collapsing, and silver was whipsawing between $30 and $50 intraday. Then came January 14th. Asian markets opened with silver at $88.50. By 2 a.m. Eastern, $90. By 6 a.m. London time, $91.40. As I'm recording this at 11 a.m. Eastern, silver is trading at $90.80, consolidating just above the psychological barrier. That's the timeline. Now let me show you what caused it. The three catalysts. Every major price explosion requires three elements: a supply crisis, a demand surge, and a trigger event. All three converged in this 48-hour window. Catalyst 1. The supply crisis. This has been building for months. According to data from the Silver Institute, global silver production in 2025 fell approximately 7% compared to 2024. Mine production from Mexico, the world's largest silver producer, declined due to ore grade depletion and regulatory challenges. Peru faced similar issues. China, which produces roughly 12% of global supply, reportedly reduced exports as part of strategic resource accumulation. Simultaneously, industrial demand surged. Solar panel installations in 2025 reportedly exceeded projections by 23%. Each panel requires approximately 20 grams of silver. Electric vehicle production increased, with EVs using roughly 25-50 grams of silver per vehicle compared to 15-20 grams in traditional vehicles. 5G infrastructure build-out continued accelerating, with each 5G tower reportedly using 3 times the silver of a 4G tower. The math is brutal. The Silver Institute estimates a structural deficit of approximately 200 million ounces in 2025. That is production minus consumption. For context, total annual mine production is roughly 830 million ounces. A 200 million ounce deficit means the market consumed 24% more silver than was mined. Where did that deficit come from? Above ground stockpiles, COMEX inventories, ETF holdings, private vaults. For years, the market has been draining accumulated reserves to meet current demand, and those reserves are finite. On January 10, 2026, COMEX reported that registered silver, metal available for delivery against futures contracts, had fallen to 47 million ounces. That's the lowest level since the Silver Institute began tracking the data in 1990. For comparison, registered inventories were above 120 million ounces in early 2024. Here's why that matters. Open interest in COMEX silver futures represents claims on approximately 560 million ounces, but only 47 million ounces are available for delivery. That's a ratio of 11.9 to 1. For every ounce of deliverable silver, there are nearly 12 paper claims. This is the classic setup for a short squeeze. Not everyone can take delivery, not even close. And when market participants realize this, they scramble to secure physical metal before it's gone. Catalyst 2, the demand surge. While supply was tightening, demand was exploding from an unexpected source: institutional buyers. Reports began circulating in late December 2025 that several sovereign wealth funds were allocating to physical silver. The Abu Dhabi Investment Authority reportedly purchased silver bullion. Singapore's GIC was mentioned in market commentary. And persistent rumors suggested that China's State Administration of Foreign Exchange was diversifying reserves into precious metals beyond gold. None of this is confirmed. Sovereign wealth funds rarely disclose positions in real time, but the price action and volume patterns are consistent with large, sustained institutional buying. Additionally, retail demand never subsided from the 2023-2024 surge. According to dealer reports, premium spreads on physical silver coins and bars remained elevated throughout 2025. American Silver Eagles, when available, were trading at $812 over spot, generic rounds at $5.7 over spot. These premiums indicate persistent physical demand that exceeds available supply. ETF inflows tell the same story. The iShares Silver Trust, SLV, reported net inflows of approximately 28 million ounces in December 2025 alone. That's the highest monthly inflow since April 2020. Other silver ETFs showed similar patterns. Combine industrial demand that's structurally higher than supply, institutional accumulation, and persistent retail buying, and you have demand pressure from all three major buyer categories simultaneously. Supply crises can simmer for years, demand can build gradually, but price explosions require a trigger, an event that forces immediate action and breaks the suppression mechanisms that have kept prices contained. The trigger came on January 11th, 2026. Though details remain scarce, multiple reports from banking sources suggest that a major financial institution faced a margin call on its short silver position. The institution has not been publicly named, but analysis of COMEX position data indicates one of the top 5 commercial shorts reduced its position by approximately 18,000 contracts, roughly 90 million ounces over a 36-hour period. To close a short position, you must buy. Buying 90 million ounces in a market with only 47 million deliverable creates a mathematical impossibility. The institution couldn't take delivery of physical silver because it doesn't exist in sufficient quantity, so they had to settle in cash and buy back their futures contracts at whatever price the market demanded. This is what's called a forced liquidation, and forced liquidations create cascading effects. As the institution bought to cover, prices rose. Rising prices triggered stop-loss orders from other short sellers. Those stop-losses became buy orders, pushing prices higher still. Higher prices triggered margin calls on additional short positions, forcing more buying. This is the short squeeze mechanism. It's self-reinforcing. Once it starts, it accelerates, until either the shorts are fully covered or the market breaks entirely. By the time New York opened on January 13th, the squeeze was in full force. And because COMEX registered inventories are so low, physical delivery became impossible for most contract holders. The paper market, which has suppressed silver prices through derivatives for years, suddenly lost credibility. When paper promises can't be fulfilled with physical metal, the paper price becomes irrelevant. Only physical matters, and physical silver was trading at premiums of $15.20 over the COMEX spot price by January 13th afternoon. The historical pattern. None of this is new. We've seen this pattern twice before in modern history, and both times the outcome followed a predictable sequence. 1979 to 1980, the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt began accumulating silver in 1973. By 1979, they reportedly controlled approximately 100 million ounces. roughly one-third of deliverable supply at the time. Silver was trading at $6 per ounce in early 1979. By January 1980, it hit $49.45. That's a 724% gain in 12 months. What happened? The Hunts created a supply squeeze. They took delivery of physical metal, removing it from available supply. As inventories fell, prices rose. Rising prices triggered short covering. Short covering accelerated the rise. The parallel to today is striking. Except this time, it's not two billionaires. It's industrial demand, institutional buyers, and retail investors all competing for the same finite supply. And unlike the Hunts, who were individuals operating outside the system, current buyers include sovereign wealth funds and central banks, entities that cannot be easily stopped by regulatory changes. The 1980 peak at $49.45, inflation adjusted to January 2026 dollars equals approximately $185. We're at $90. If the pattern repeats with similar intensity, there's substantial room for further appreciation. 2010-2011, the post-crisis rally. After the 2008 financial crisis, silver was trading at $8.88 in October 2008. By April 2011, it hit $48.70. That's a 448% gain in 30 months. What happened? Quantitative easing. The Federal Reserve printed $2.3 trillion between 2008 and 2011. Investors, fearing currency debasement, fled to hard assets. Gold rose, but silver rose faster because it's more volatile and was more undervalued. Today, we're seeing similar dynamics. Federal Reserve balance sheet expanded significantly during 2020-2021 and has remained elevated. The dollar index, which measures the dollar's strength against a basket of currencies, has fallen approximately 8% since its October 2023 peak. When the dollar weakens, hard assets priced in dollars tend to rise. Additionally, the fiscal situation has deteriorated. U.S. national debt exceeded $38 trillion in January 2026. Interest payments on that debt approach $1 trillion annually. Deficit spending continues at approximately $2 trillion per year. These are unsustainable trajectories, and markets are beginning to price in currency risk. In both 1980 and 2011, silver's explosive moves were driven by supply-demand imbalances amplified by monetary concerns. Both conditions exist today, arguably more intensely than in either previous episode: the paper market versus physical reality. Here's what most people miss: silver trades in two distinct markets. The paper market, futures contracts, ETFs, derivatives, and the physical market, coins, bars, industrial supply. For decades, the paper market has dominated price discovery. COMEX futures. Trading volume dwarfs physical transaction volume. When traders talk about the silver price, they mean the COMEX spot price derived from futures contracts. Physical silver typically trades at a small premium above this price to account for fabrication and distribution costs. But this 48-hour event has exposed a critical disconnect. While COMEX silver hit $90, physical dealers were quoting prices of $105 or $110 for immediate delivery on standard products. That's a $15, $20 premium, roughly double the historical norm of $5, $8. This spread indicates that the paper market has lost its credibility as a price discovery mechanism. When paper promises are plentiful but physical metal is scarce, buyers will pay premiums for actual possession. And when premiums reach this level, it suggests the paper market is no longer reflecting reality. Several major dealers reported on January 13th and 14th that they had implemented allocation systems or temporarily suspended taking new orders due to supply constraints. The U.S. Mint's Silver Eagle suspension, which began in March 2025, has not resumed as of this recording. The Royal Canadian Mint has extended delivery times to 16 weeks. Perth Mint in Australia is quoting similar timeframes. These are not temporary shipping delays. These are supply chain failures at the mint level, indicating that refined silver suitable for coinage is unavailable in sufficient quantity. What happens next? Based on historical patterns and current market structure, several scenarios seem probable. Short term, next 2 to 4 weeks. Volatility remains extreme. Silver could consolidate between $85 and $95, or it could spike to $110 or $120 if additional short covering occurs. The key variable is whether more large commercial shorts face margin calls. If registered COMEX inventories continue falling, and they have dropped approximately 15 million ounces in the past month, additional forced liquidations become likely. Physical premiums will likely remain elevated or increase further. Dealers who secured inventory early will have pricing power. Those who didn't will struggle to source product. Expect continued reports of extended delivery times and allocation systems. The ratio between silver and gold will be watched closely. Historically, silver trades at approximately 15-20 ounces per 1 ounce of gold. Medium term, next 3 to 6 months. Industrial demand remains strong regardless of price volatility. Solar panel manufacturers, EV producers, and electronics companies need silver. They cannot substitute it effectively in most applications. If silver prices remain above $90, some demand destruction may occur in less critical applications, but essential uses continue regardless of price. Mine production will not increase meaningfully in this time frame. Bringing new mines online takes years. Existing mines are operating at capacity or facing ore grade depletion. The only variable supply source is recycling, which historically accounts for approximately 15-20% of total supply. Higher prices incentivize more recycling, but the scale is insufficient to close a 200 million ounce structural deficit. ETF flows will be critical. If institutional and retail investors continue buying silver exposure through ETFs, that creates additional demand for physical metal to back those shares. SLV alone would need to acquire approximately 100 million additional ounces to satisfy current inflow trends if they continue at December 2025 levels. Long term, 6 to 18 months. The ultimate question is whether this represents a new secular bull market in silver or a temporary spike that retraces once short covering completes. Historical precedent suggests that moves of this magnitude, 18% in 48 hours, breaking all-time highs, typically occur in the late stages of extended bull markets or during systemic financial stress. Both conditions may apply currently. If the structural supply deficit persists and industrial demand continues growing, silver would need to reach prices that either destroy significant demand or incentivize massive new supply. Given lead times for mine development and the critical nature of many industrial applications, the price required to balance supply and demand could be substantially higher than current levels. Some analysts have suggested that silver could reach $150-$200 within 18-24 months if the supply squeeze intensifies and monetary conditions remain favorable. These are not predictions, but scenario analyses based on supply-demand fundamentals and historical patterns. Whether they materialize depends on variables that remain uncertain. The broader context. Silver's move to $90 is not occurring in isolation. It's part of a broader pattern of asset price volatility and currency concerns. Gold breaking $4,200 suggests investors are questioning fiat currency stability. Bitcoin's strength despite regulatory uncertainty indicates similar concerns. Treasury yields rising while stocks remain elevated creates a dangerous combination historically associated with financial stress. The dollar's decline, while modest in percentage terms, represents a significant shift in confidence. For decades, the dollar has been the unquestioned global reserve currency. Recent developments, BRICS nations discussing alternatives, central banks accumulating gold at record rates, oil transactions, increasingly settled in non-dollar currencies, suggest this dominance may be eroding. If the dollar's reserve status continues weakening, hard assets like silver become increasingly attractive as stores of value. This isn't speculation. This is the pattern that has played out throughout history when reserve currencies lose credibility. Rome debased the denarius. Byzantium debased the solidus. Britain's pound lost reserve status after World War II. Every previous reserve currency eventually failed. The dollar may be different, but history suggests caution. What this means, practically, for those observing these markets, the 48-hour move to $90 represents a significant structural shift. Whether prices continue rising, consolidate, or partially retrace remains uncertain. But several implications seem clear. The paper silver market's credibility has been damaged. When physical premiums reach $15-$20 over spot, it indicates that paper prices no longer reflect physical reality. This divergence may widen if supply constraints intensify. Physical silver availability will likely remain constrained. Mints are struggling to source refined blanks. Dealers are implementing allocation systems. Retail buyers face extended delivery times and elevated premiums. These conditions suggest sustained supply stress rather than temporary disruption. Industrial users face difficult decisions. If silver remains above $90, manufacturers must either accept higher input costs, find substitutes where possible, or reduce production. All three outcomes have economic implications. Investment demand shows no signs of abating. ETF inflows continue. Retail buying persists despite high premiums. Institutional interest appears to be growing. If these trends continue, they add demand pressure to an already tight market. The most important observation is this: the move to $90 occurred in 48 hours. That's not gradual price discovery. That's a structural break. And structural breaks typically signal that the previous equilibrium has failed and a new one is forming at a different price level. Whether that new equilibrium forms at $90, $120, or $60 remains to be seen. But the velocity and magnitude of this move suggests that something fundamental has changed in the silver market. The final question: what just happened in 48 hours? Silver broke out of a 4-decade trading range, demolishing resistance levels that have held for years. It moved 18% in 2 days, experiencing the most extreme volatility since 1980. Physical premiums exploded. COMEX inventories collapsed. A major institution reportedly faced forced liquidation of a massive short position. But the deeper question is this: what happens now? History provides patterns, but not certainties. 1980 saw silver peak at $49 and crashed at $10 within months. 2011 saw silver peak at $48 and decline to $14 over 4 years. Both episodes ended with severe retracements that destroyed late buyers. But both episodes also began with the same pattern we're seeing now: accumulation, suppression, break, and explosion. We've just entered the explosion phase. Whether it continues or reverses depends on factors that remain fluid: COMEX inventory levels, additional forced liquidations, industrial demand trends, monetary policy decisions, and global currency dynamics. What's certain is that silver at $90 has crossed a threshold. All-time highs are psychologically significant. They attract attention, they bring new buyers, and they force those who doubted the move to reconsider their positions. The next 2 to 4 weeks will likely determine whether this is a historic breakout or an extreme spike that retraces. Watch COMEX registered inventories. Watch physical premiums. Watch the commercial short positions. Watch the dollar index and treasury yields. The data will tell the story before the media does. And if you're paying attention, you'll see the next phase forming before it becomes obvious to everyone else. Because this isn't just about silver. This is about what silver is telling us: that the paper promises stacked on paper promises may finally be running into physical reality. And when that collision occurs, prices adjust to reflect scarcity rather than abundance. We just witnessed 48 hours of violent price adjustment. Whether it was the beginning of something larger or an isolated event will be determined by what happens next. The pattern is clear. The data is public. The choice of how to interpret it remains yours.